Most people give their wallet, but the most impactful donors give from their wealth or appreciated assets. We tend to donate from what feels liquid, like checking accounts, savings, reoccurring giving, but that isn't where most of our wealth lives. A small shift in thinking can unlock a very different level of generosity, not because someone gives more out of pocket, but because they understand how to give in smarter, more strategic ways. Years ago in Dallas, I was sitting in a small office, fluorescent lighting, folding chairs, a stack of pledge cards on the table, and across from me was a woman in her 60s, a lifelong supporter of this organization. She looked at me and said, "Kirk, I wish I could give more, but I'm terrified from running out of money." When we opened up her full financial picture, we realized she was sitting on highly appreciated stock that she rarely thought about. By giving shares instead of writing a bigger check, she avoided large capital gains tax, supported the charity at a level she never dreamed was possible, and still felt completely secure about her retirement. She walked out of that meeting lighter, same net worth, totally different sense of impact. That's when it really hit me. Generosity is not limited by desire, it's limited by strategy. For more than 2 decades, I lived at the intersection of generosity and financial planning, helping families, business owners, and nonprofits design giving that actually fits real life. I'm a military veteran, a CFP, and I've helped raise millions of dollars for charities here in Dallas by helping donors see what's possible beyond the checkbook. My role isn't to sell you a product or push for a particular charity, it's to show you the practical ways you can give more confidently, more tax efficiently, and more joyfully using the tools that most people either haven't been shown or don't fully understand. We often use the word donor, but I want you to think of yourself as an investor in change. You're not just funding a budget line, you're backing values, people, and ideas that you believe should exist in the world. Just like a wise investor doesn't throw money at random stocks, a wise giver doesn't give randomly. They align their giving with the outcomes and stories that matter most to them. When you see yourself as an investor in impact, generosity stops feeling like subtraction and starts feeling like you're building something. Most nonprofits ask for cash, but cash is usually the smallest portion of the average household's wealth. The real weight sits in things like your investment portfolio, your retirement accounts, your business, your real estate. When you only give from cash, you're fighting with your monthly budget. When you learn to give from appreciated assets, you're shifting gifts out of places where taxes would eventually erode them anyway. It's the difference between squeezing, giving into what's left versus building generosity directly into your wealth strategy. If you listen closely to major donors, they rarely talk about tax deductions first. They talk about legacy, about grandkids, about the moment their name shows up on a wall or a scholarship letter arrives to a student they'll never meet. They want to see their values outlive their paycheck. What they're craving isn't a receipt, it's a story they can tell themselves and their family. This is what we stand for. This is what we built together. When your giving is connected to the sense of meeting, the numbers often follow. Here's a surprising reality. The largest charities in America aren't soup kitchens or hospitals. They're donor structures like donor advised funds, private foundations, and charitable trusts. These vehicles hold staggering amounts of charitable capital because they're designed to fit how wealthy families actually manage money with planning, flexibility, and tax awareness. When donors understand and use these tools, they're suddenly playing in the same arena. Giving becomes larger, more strategic, and often more satisfying because it fits the way they already think about money. The difference between giving casually and giving strategically is rarely about generosity, it's about structure. A few adjustments to how giving is planned can result in larger gifts, better tax efficiency, and more meaningful outcomes for causes you care deeply about. Before we talk about donor advised funds, QCDs, or trust, it's important to remember that tools don't create generosity. People do. A hammer is only useful if you know whether you're building a birdhouse or a cathedral. In the same way, the best charitable vehicle for you depends on the story you want your giving to tell. Ongoing support for a cause, legacy for your family, income during retirement, or a single transformational gift. Once intention is clear, the tools become incredibly powerful. There are four core vehicles that consistently help donors give more effectively, reduce taxes, and support long-term philanthropic goals. You don't need all of them. Most people begin with one and expand over time as their giving vision grows. Imagine setting aside money for generosity the same way you'd set aside money for retirement, intentionally, thoughtfully, with room to grow. A donor advised fund lets you take a deduction today, even if you're not ready to choose the charity yet. Many families describe it as creating a personal, charitable giving account, just with better tax treatment, investment growth, and far fewer administrative headaches. You contribute cash or appreciated assets, stock, real estate, or crypto, and receive an incredible deduction. The funds can be invested and grow tax-free until you're ready to recommend grants to nonprofits you care about. For many families, it becomes a tool for teaching children and grandchildren how to approach generosity thoughtfully. Most people imagine DAFs as a tool only the ultra wealthy use, but many donors start with small contributions. There's no required complexity, and with the anonymity and timing control, donors often find themselves giving more freely and more joyfully. For anyone over age 70 and a half with an IRA, qualified charitable distributions are often the single most tax efficient way to give. Instead of taking a required minimum distribution and paying taxes, you can give directly from your IRA to charity, and that amount bypasses taxable income entirely. The IRS essentially says if you give it away, we won't tax it. A $20,000 required minimum distribution might result in only $15,000 after taxes. But a $20,000 qualified charitable distribution goes entirely to impact. No tax owed. Same dollars leaving your account, radically different results. A charitable remainder trust feels almost counterintuitive. You give an asset away, yet you still receive income from it. You can contribute appreciated assets and bypass capital gains tax. The trust pays you or beneficiaries annually, and when it ends, the remainder goes to charity, often creating a legacy gift that's much larger than expected. I once worked with a retired engineer with a large concentration in a single stock. He wanted dependable income and meaningful impact. Instead of selling and triggering taxes, he placed shares in a charitable remainder trust. The trust diversified the assets, paid him income every year, and ultimately funded a scholarship at his favorite charity, turning anxiety into pride and purpose. There isn't just one type of charitable remainder trust. There are variations designed for different goals. Unit trust adjusts for market performance, while an annuity provides predictable payments. Testamentary charitable remainder trusts allow gifts upon death, supporting loved ones and a charity at the same time. Estate gifts are often the largest donations a person ever makes, yet fewer than 5% of the people include charity in their will. Those who do often begin giving more during life because giving now feels connected to a bigger story, one that continues long after they're gone. As we age, our awareness of time changes, and so does our desire for a legacy. A charity can do something we cannot. It can live forever. When your giving creates a story that continues after you, generosity becomes more than a transaction. It becomes part of who you are. An endowment sustains a cause through predictable, ongoing support. The principal remains invested while the earnings fuel the mission year after year. For many donors, it feels like planting a seed that becomes a forest. something that grows beyond what you could have built alone. Timing can dramatically multiply the effect of generosity. Giving during a high income year provides greater tax benefit. Pairing charitable gifts with a Roth conversion softens tax impact. And donating shares before selling a business or property can eliminate capital gains entirely. A timing aware plan turns ordinary giving into strategic generosity. Most of the largest charitable gifts happen with the help of a financial advisor, not because donors lack generosity, but because generosity at scale requires alignment. A great advisor ensures you're not jeopardizing retirement, accidentally disinheriting heirs, or missing opportunities to give more effectively. There's no single best charitable strategy, only the strategy that aligns with your values and stage of life. Some start with a donor advised fund, others with a QCD or a legacy gift. What matters most is clarity, knowing what you believe and building generosity around that foundation. You already care, you already give. Today isn't about changing your heart, it's about empowering your generosity with strategy. The next step isn't perfection, it's curiosity. What cause matters most to you? What story do you want your giving to tell? And what would it look like to give not just more, but smarter, more confidently, and with deeper purpose?